Welcome to The Explainer. Today, we're going to deconstruct an investment case for HEROMOTOCorp. You know them, they're the world's largest two-wheeler manufacturer. We're going to dig in and see what the numbers really tell us about where this company is headed.
All right, so here's how we're going to tackle this. We'll start with the big takeaway, the final verdict. And then we'll rewind and walk through all the pieces, the financials, the business model, the risks, to see exactly how they got there.
Okay, first things first, the verdict. After all is said and done, what's the bottom line on HEROMOTOCorp?
So the final call is accumulate. This isn't a screaming buy right now, but more of a steady build a position. We're talking a 3 to 5 year horizon here. And look at that fair value range, somewhere between 5,200 and 6,800 rupees a share. That suggests there could be some pretty decent upside from where the stock is trading today.
In this accumulate rating, it's not just a gut feeling. It's built on some really solid ground. I mean, you've got world-class profitability, you've got some seriously powerful recent growth, and, maybe most importantly, a balance sheet that's practically a fortress.
All right, let's peel back the layers and get into the numbers. How do the financials actually back up this call?
You know, when you look at their long-term performance, it's really a tale of two different stories. For about 10 years, revenue growth was, well, it was kind of sluggish, just chugging along at 4%. But then, bam, look at the last 3 years. That growth rate has shot up to 11% compounded, and profits, they've just exploded, growing at 24%.
And this really gets to the heart of the matter, doesn't it? This is the big question you have to ask yourself as an investor. Is this recent explosion in growth just a temporary blip, a cyclical thing? Or is this the start of something totally new, a whole new chapter for this massive company? Okay, let's talk about the balance sheet, because honestly, it's incredible. We're talking almost zero debt. But get this, the company is sitting on a huge pile of cash and investments. So big, in fact, that it's worth more than 14% of the entire company's value. That's a massive safety net for any investor.
So, what does that mean for you, the investor? Well, it means this business is basically a cash machine. It generates a ton of cash, and instead of just sitting on it, they give a huge portion of it, we're talking almost 3/4 of their earnings, right back to shareholders in the form of dividends.
So we know the financials are rock solid, but that leads to the next big question. How well do they actually run the business? How good are they at turning money into, well, more money?
If there's one single number that tells you about the quality of this business, it's this one right here, 30.3%. That's their return on capital employed, or ROCE. And what that means is, for every 100 rupees they put into the business, they get back over 30 in profit. That is an incredibly powerful engine.
But wait, it gets even better, because while they're earning that 30.3%, it only costs them about 12% to fund their operations. That gap, that 18% spread, that's pure value being created for shareholders. That is the sign of an absolutely exceptional business.
And what's really crucial here is how they're getting these great returns. It's not through some kind of financial trickery like piling on a bunch of risky debt. Nope. The analysis shows it's coming from real, genuine improvements in their profit margins. Their core business is just getting better and more efficient. And that, right there, is the hallmark of a high-quality company.
Okay, let's switch gears and look at the business itself. Every great company has a competitive advantage, right? An economic moat that protects it. So where does Hero's moat come from?
Now, this is fascinating. When you put Hero side by side with its competitors, it's a huge disconnect. Hero trades at about 18 times its earnings. Look at the others. Bajaj, TVS, Eicher, they're all trading at 30, 33, even 55 times earnings. So you have to ask, why is the market valuing Hero so much lower? What's the story there?
And this is part of the answer. Hero is actively changing its stripes. Yeah, they're still the king of the basic commuter bikes. That's about half their business. But look at this. Premium bikes now make up a full quarter of their revenue. And that's a big deal, because that's a higher growth, higher margin space. They're not just a one-trick pony anymore.
So that moat we talked about, it's built on 3 really strong pillars. First, just pure scale. Being the biggest gives them huge cost advantages. Second, their brand. It's a household name built over 40 years. And third, their network. Over 6,000 dealers and service centers. Try competing with that. But of course, no investment comes without risk. So let's get real and weigh the good against the bad. What's the bull case versus the bear case here? And this slide just lays it all out, doesn't it? It's really 2 competing stories. The bull case says, look, you've got this market leader, It's financially indestructible, it's diversifying, and it's cheap. But the bear case fires back. Not so fast. This is a slow-growing giant about to get disrupted by nimbler competitors and the whole EV revolution.
And you can't just ignore these risks. They are very real. First, you've got that decade of slow growth we talked about. It's a real concern. Second, the transition to electric vehicles. Their EV brand, VIDA, is still losing money, and that's an expensive bet. And third, something a little more subtle, for a family-run business, the founders own a relatively low stake. It just makes you wonder a little bit about their long-term conviction.
Okay, so after looking at all of this, the good, the bad, the ugly, how does it all add up? Let's look at the final score.
This valuation chart really puts the risk-reward in a perspective. In the things go as expected base case, you're looking at maybe a 14% upside. Not bad. But if that bull case plays out, if their big bets on premium bikes and EVs really pay off, well, then you're looking at a potential upside closer to 36%. Now that's pretty compelling.
And so when you crunch all the numbers, when you weigh all the pros and cons, the investment case scores a 73.8 out of 100. That's a solid B grade. And that aligns perfectly with that initial recommendation we saw, accumulate.
So I think the big takeaway from all this is the question it leaves you with. With that fortress of a balance sheet and a stock price that's so much cheaper than its peers, you have to ask yourself, is the market right to be so cautious? Or is it completely overlooking the next chapter in Hero's story? A chance to get in on a market leader right as it's reinventing itself.